Good afternoon for you, or good morning. It's 11 o'clock. I'm still in Vancouver, 2 o'clock in New York on Monday, the 23rd of May. I'm recording this a day early because I'm in Vancouver and my schedule is a little bit in flux. I have stayed in Vancouver because I contracted COVID, and thus I'm in sequestration in a friend's carriage house in Vancouver. I hope to fly back later this week once I can get the required tests and clearance letter and a flight out of here. That means that I probably will not be having an open forum on Wednesday because as it looks right now, I will be in the air on Wednesday. We haven't really sent out invitations to clients on that, and we'll reschedule it and we'll send out invitations. Our dance card's starting to get busy because we're moving toward the PDAC, and we will have an open forum on silver on June 1st, as it is. What I wanted to talk about today is this presentation I have here, gold and silver supply, above ground inventories, and in-ground reserves. This is one of the presentations I made at the Vancouver Resource Investment Conference last week, and I thought it was probably worth addressing. My alternative was to talk about the current status of the macroeconomic environment, fact that gold, silver, stocks, oil, other commodities, bond prices are all up today as people sort of reassess whether or not there is an imminent recession. But I think that dealing with substantive things on gold and silver probably is more interesting to more readers or viewers of this. So I thought I'd go through this. And a lot of it is stuff that we've already talked about, but we'll talk about it again. First off, this is the total supply of newly refined silver or gold entering the market every year. And you can see that the vast majority of it is newly refined metal coming from mine production on a global basis. You can also see that mine production has gone from 30 million ounces in the late 1970s, 32 million ounces to much higher levels really since 2017 when we reached our last peak. Production has recovered from a couple of years ago, from 2020. It's still in recovery phase. The red part is very important, and as you can see, is growing, and that is secondary recovery of gold from old scrap, not new processed scrap in the manufacturing process, which is enormous, but tends to stay in a closed loop financially and physically. But rather end of life gold that comes out of jewelry and decorative items and electronics and a host of other manufactured equipment that uses gold in fabrication as opposed to bullion and quasi-bullion coins. So what you see is growth there, and that growth is a reflection of several factors. One of them is the growth in fabrication demand for gold over the last 40, 50 years. As the use of gold in fabricated products has grown, so too has the recycling of that gold from those fabricated products. You also have other factors. The higher price in gold has attracted more recycling of jewelry than when gold was $35 an ounce. And also the increase in environmental regulations. So you now have end-of-life recycling requirements in many countries where when you have old electronics equipment, you're supposed to turn it in and that gold is recycled as opposed to being thrown in dumps. That's the flow of metal in. And if you know money and banking 101, think of that as the current account for gold supply. There's a capital account, and this is the new capacity of material. And unfortunately, this chart only goes back to 2011. If you had gone back further, you'd see the 2011, 12, and 13 were relatively high by previous standards. And that reflected the increase in price of gold at that time, and really from 2001 to 2012 on an annual average basis, which had brought a lot of projects into development. And then as the price of gold fell after 2011, 2012, what you saw was that a lot of exploration and development activity was turned off. So the pipeline has closed down. It's not a permanent closure. It's a cyclical one related to the price of gold. And if you go fast forward a few years from now, you will probably be seeing this increase because there is a lot of gold that can be developed into operating mines on a global basis. These are two charts on gold bullion in refined bullion form. On the left-hand side is Comex gold, record levels. And when I say record levels, I'm saying like we're not, we're talking about three or 3.5 times as much metal as used to be in Comex. And the Comex stocks, I should point out, are 100-ounce bars or kilo bars stored in Comex registered vaults that meet the Comex specs. There's additional gold in some of those vaults, but if it doesn't meet the Comex specs, it doesn't get reported. On the London side, this includes all gold bullion that is stored in LBMA registered vaults and the Bank of England. And the Bank of England has the lion's share of it, as it should, as the sovereign, I guess, in that country. And that actually includes not only the 400-ounce gold bars that are good delivery in the London market, but also 100-ounce bars, kilo bars, coins, and other things. So all refined gold that are held in those depositories. And it must be noted, there are depositories outside of London and on the fringes of London that are not registered and are not recognized by the London Bullion Market Association, and therefore they have gold too, but it's not inside that loop of reporting depositories. So there's a lot of gold in refined form, and gold ETFs represent another portion of that, and obviously a portion of what is held in London and in New York and reported in London and New York is actually held by ETF managers, and is there a lot of gold. On a cumulative basis, this is a chart that we've been updating since the 1970s. You have about 5 billion or 6 billion. Let me just grab my glasses. I'm sorry here. I've got some nasty glare. About 6 billion ounces of gold that's mostly been mined, that is estimated to have been mined since antiquity. And, again, 95% of that probably has been mined since 1900. So it's relatively higher assurances. It's that first 50 to 100 million ounces that was estimated to have been mined prior to 1800 and the Industrial Revolution. It's questionable. And, unique to gold, a lot of that stuff is relatively identifiable. 1.3, 1.4 billion ounces in investment stocks, about 1.1 billion ounces in central banks, and then about nearly 3 billion ounces in jewelry. And then these are reserves. And you can see, there's the reserve and there's the reserve base. Resources, unfortunately, are not reported. And that's because resources is a much more difficult number to come by. But you can see from the reserves and the reserve base that we have more mineable reserves in the ground than ever before. So the world's not running out of gold to be mined. It's not running out of refined gold that exists above ground. And it's not running out of power to do it. Insofar as you have cyclicality in the current account of supply and demand, it reflects fluctuations in the prices, and it reflects the activity of humankind. It doesn't reflect a shortage of gold to be mined. It reflects humans' reluctance to mine it at any given time, or their inability to mine it efficiently at any given time. So turning to silver, it's pretty much the same story. Total supply of silver, including secondary recovery, is back to 2018 levels. Now, I'll point out, you can see government disposals, and they kind of dwindled away by 2008. There are some people who think that there's still gold or silver trickling out of government inventories. Those inventories that you see being sold are not monetary reserves. Silver has never been a monetary reserve, at least in modern times. It was used in silver coinage, and it was used to actually to back the US dollar and other currencies prior to, well, the dollar got out of it in the 1960s. And most other countries that use silver in a monetary reserve basis and for circulating coinage and to back certificates got out of the business of using silver and money in the late 70s, early 80s. There is financial stocks, and we'll get back to that in a second, but this is current account from new material, and we're back to 2018 levels. So again, it's there. Just as with gold, as you see, you had a lot of new capacity coming on stream 2013. It dwindled over the subsequent years because of the lower price and the dwindling of capital, either through equity or debt, for mining companies to develop those mines. As we've seen higher prices now, we fully expect to see the amount of silver being mined and being developed into future mines to start rising, possibly as early as 2023, maybe even in 2022. There is a lot of silver out there to be mined. These are our silver bullion inventories. The green stuff is coins. You have seen a continual shift away from bullion bars to official coins since the maple leaf and eagle, and then subsequently other coins were created starting in the mid-1980s. And you've seen an increased use of silver ETFs to hold metal. So if you look at it and you discriminate between changes in silver inventories year over year, what you see is that really over the last several years, many years, you have seen an increase in investment demand for silver in coin form and in ETFs, and you've actually seen net sales of 1,000-ounce bars by investors who have converted their 1,000-ounce bar positions into coins and ETFs. It's not that they're getting out of silver, they're just moving into smaller denomination or more flexible and different types of ways of holding silver bars. Any of you who have ever moved 1,000-ounce bars know that it's a lot nicer to move coins or shares electronically in an ETF than it is to have these 1,000-ounce bars stacked up. So that's the bullion above ground. Near record silver inventories. And again, as I said with gold, you're not talking about near record saying, oh, wow, we're past where we were. You're saying, oh, we're talking about 2 to 3 times as much silver out there as regular. I'm going to say something about regular versus registered stocks. You found people who don't necessarily know what they're talking about silver and gold are those kinds of things that you don't need to be an expert to think you're an expert about. And one of the things that you hear that's very funny is you never see the registered stocks being delivered. And that's because you cannot financially deliver registered stocks. All of the fluctuations in eligible stocks come from registered stocks. So when you deliver silver or gold into Comex depositories, you get a warehouse receipt. That is for an eligible stock. If you register that receipt with the Comex, it becomes registered stock. If you want to sell it, then you have to deregister it, and it goes back into eligible stocks, and then you can deliver that eligible stock. So when there are people who don't know better saying, oh, you never see any registered stocks being delivered on, that's because you don't deliver registered stocks. You deregister them and then you deliver them. And there are these guys out there, somebody said they were sort of like the Three Stooges, but I think there were like four of them or so, who have been diddling around on the internet saying, oh, we can't take delivery of a 1,000-ounce bar from Comex. And they've done this for months. Typically, 700,000-ounce bars are delivered out of Comex eligible stocks every day. Now, when I say delivered out of Comex eligible stocks, that means that somebody owns that depository receipt and he or she or it transfers ownership of that silver and the depository receipt attached to it to somebody else who may keep it in eligible stocks, may re-register it, or may take it out. But on average, about 700,000-ounce bars a day come out of Comex inventories. So, and the delivery period is 2 days. Anybody who takes more than 2 days to take delivery of a silver bar is either totally beside themselves as to not knowing what to do and how to do it, or they're trying to dupe people into thinking that it's hard to take metal out of inventories. It is not hard. Many sophisticated and not so sophisticated people do it every day. And if you're having trouble, well, CPM Group can be your advisors, and we can show you how the market actually works. Ample inventories also exist in Shanghai on the left and in London on the right. Again, the world is not running short of refined silver in bullion and bullion coins form. If you want silver, it's there. The wrong way to think about Comex silver inventories is, oh, look at open interest and inventories are only half of that. Well, that's true, but that's okay because 99% of the people who have open interest don't want to take delivery. They want price exposure. They don't want physical silver. They want price exposure on a leveraged basis. I'm going to buy a Comex future. I am going to put down 10 or 15%. So I have a nice leveraged approach to my silver exposure. And the last thing I want to do is put up 100% and take physical delivery. So 95% or more. You can see here at the bottom, the deliveries are a fraction of what the total inventories are. And if you look at it in percentage terms, you can see it's basically been 10% or less, and by less, I mean a lot less, for most of the last 12 years or so. It's funny because it used to be a little bit more, but that was back in the days when certain fabricators were using the Comex to take delivery. So you would have certain silver producers who would regularly deliver their silver into the Comex and register it and take a position for 1 to 3 months. And then their industrial using clients would buy that metal and take delivery of it out. And that was the case in the 70s and 80s and 90s into the aughties. You might notice that this seems to have diminished in line with the photographic industry's reduction in use of silver. That's because some of the companies that were involved in this were photo companies, but there were other companies in other industries that did that. And in the past, they would pick up the contango, the producers, and there were financial benefits to delivering your metal through the Comex. As time progressed, those financial advantages disappeared. In many cases, people who were not involved in the Comex, that were involved in the over-the-counter market, made products available that were equally financially beneficial. So you saw a shift away from using the Comex as a place where you would drop in stuff. But notice that even in the glory days, yeah, you had a couple spikes higher, but for the vast majority of the time, it was 20%, 30% at the most that actually was delivered upon. And these are inventories versus deliveries, not open interest. You really need to know the market before you talk about it, except you don't, because it's a free world. Finally, silver reserves and reserve base, as with gold, but even more so, we have more reserves than ever before, even though we mined billions of ounces of silver. I mean, you can see in 1988, we had reserves of about 8 billion ounces. Between 1988 and today, we've probably mined something like 30 billion ounces, just off the top of my head. So we have twice as much reserves now as we did then. We're not running out of silver. Another thing that folks say is, oh, well, we're running out of silver, and you can tell that because the average grade is falling. The average grade is falling because the average price is rising. And as the price rises, responsible miners mine the average payable grade. So at $7.26 in 2005, they were mining an average grade of 13%. And as the price rose, the average grade declined. It's not that we're running out of silver. It's not that we're running out of high quality silver. At the VRIC and in a variety of other venues, you will find all sorts of companies with really interesting high-grade deposits that they're examining. Now that the price has gone from $15 to $20 to $22 to $26, a lot of that stuff is now economically mineable and will probably be moving toward development over the next few years, assuming that the price stays this high. And of course, if the price rises to $1,500, the way some people say, you'll see even more silver coming on stream. Even at $50 or $100, you would see a much higher volume of material being developed to be mined. But ask me when we get there, as Rick Blaine said to Colonel Strasser in Casablanca. And then again, with silver, you've got tens of billions of ounces, almost 60 billion ounces of silver, estimated to have been mined in history. And, 5/6 of it have been mined since 1900, so the numbers are relatively good. Unlike gold, a lot of this stuff is not accounted for. We know it's out there because we see it showing up in refineries every year, but it's not accounted for. All these markets are extremely private, with good reason. That's all I have for today. You can go to our website and read all sorts of other stuff. Again, I apologize for having caught COVID and having to delay the open forum, but these things happen. So take care of yourself, stay clean, stay good. And if you're like me, so socially distance for a few more days. I'll talk to you later.